All right, well, among the growing list of tech companies trimming its workforce is Salesforce, the cloud-based software giant hit with a downgrade from Cowen as elevated levels of disruption risk and medium-term overhangs on shares raises concerns. We're here to discuss is Cowen Managing Director Derrick Wood. Derrick, good to see you here. So obviously, let's talk about this activist investor move. You have Elliott Management joining Starboard Value as activists with this multi-billion-dollar stake. What does this do you think, in terms of what this perhaps signifies? What sort of context should we be putting this in?
Yeah, well, I think that there has been a push by a lot of investors to get expenses down and get margins up. We don't have a whole lot of information at this point. I suspect that the company's been in talk with management for the last couple of months. Management has definitely put out more of a structured outline of what they're going to do in terms of increasing margins. They obviously just recently announced a 10% headcount cut, and they're going to be doing some rationaling of real estate. So I think we're going to want to see kind of a little bit more prescriptive outline over the next few years in partnership with Elliott, and we'll see what Elliott wants to push. I mean, they could do things like trying to do more of a special dividend or an accelerated buyback. I mean, we already have a new buyback that has come into place, $10 billion buyback from Salesforce. They bought back almost $2 billion in the last quarter. So I think Salesforce is already doing a lot of things to appease, but we'll see what else can come about.
So do you think this is going to be much of a catalyst then for Salesforce to sort of push forward more quickly?
It could be. I mean, so Elliott's been involved in lots of software investments over the past, decade plus. If we rewound 10 years ago, they were getting involved with smaller companies and trying to kind of push for sales by, strategics or other private equity. I mean, this is a $150 billion market cap. You're not going to be pushing for a sale of this company. So then we look at what has Elliott done in past deals. One of the most recent ones was with SAP when they got involved in 2019. And there wasn't a ton of change that actually happened. There was SAP had already gone down a path of laying out how they're going to increase operating margins by 500 basis points over 5 years. And that was more of a passive involvement by Elliott. I think one thing that did come about was a one-time buyback. But it was only $1.5 billion in euros. And so it wasn't too significant, and there wasn't much change. One thing that did happen, there was a bit of C-level turnover. You did see Bill McDermott, who is CEO of SAP, leave 6 months later. And so there was a little bit of pressure at the executive level. So that's the last big software transaction they've been involved with. And we could see similar things with Salesforce.
And we know that this comes on the heels of executive departures already from Brett Taylor, Stuart Butterfield. How concerned are you about the direction of Salesforce short-term versus, say, longer-term?
That's why we downgraded last week. I mean, there's a lot of disruption happening. There's a lot of firsts, as we called it. We're looking for 13% growth in Q4. That will be the lowest growth ever. The last trough of growth during the 08-09 financial crisis was 19%. So we've broken that, and we're forecasting 10% growth next year. The level of concurrent executive departures, we've never seen this many, as you mentioned. A 10% headcount cut, we've never seen that kind of restructuring. And our argument is that sales efficiencies seem like they need to be tended to quite a bit, and there may be a lot of work to get those efficiencies in line with where they need to go. And so this 10% headcount cut may not be the first. There may be more restructuring that we're going to have to see, more iterations of getting the cost structure in place, especially since it seems like they're not doing the level of M&A they used to do over time. So still a lot of unknowns, a lot of restructuring charges that they're going to take. And hopefully they're going to be in a lot more efficient place once they get through this, but it could take some time.
And Benioff did note in that layoff note, talking about customers are taking a more measured approach to their purchasing decisions. Does this mean that sort of the best of the days are over? Can they expect the sort of hypergrowth that they were seeing before?
I mean, at this stage, at this size of the company, it's obviously hard to, I think, get back to 20% organic growth. But they're not alone in the macro right now. I mean, front office software had a little bit of a pull forward effect of investment during COVID. Now we're seeing a little bit of a hangover from that with companies slowing, the macro slowing. There's just a lot more measured buying, and they're fairly penetrated in their market. And so that's why, I mean, companies that have pretty high penetration, that are seat-based licensing models and are facing a slower headcount growth environment, are going to see tougher buying conditions, more scrutiny on budgets. And there's a lot of other companies seeing the same thing. I think there's questions as how do we navigate through this year? What's it going to look like? But it sounds like people are still, concerned that the macro could get worse, that we could go into a recession. So I think buying behavior is going to remain cautious, and that's why we're expecting roughly 10% growth this year.
And certainly, as you mentioned, there's Salesforce not alone in dealing with these macroeconomic issues still plaguing them. A big thank you there to Derrick Wood, Cowen Managing Director. Thank you for joining me this morning.